As stormy and dark market clouds gather in the skies, one sector is likely to strike the ground like a mighty bolt of lightning. It's an industry so weak I wouldn't take it to the bank. In the previous episodes, we have talked at length about the serious levels of technical weakness we now see on the markets. Mid to long term, things look dark, and unless something of significant positive magnitude takes place, traders and investors would do wise in not to expect pigs to fly. For the market is the utmost realist. It's a psychopath that loves to punish and kill dreams of disillusioned and reality-absent idealists. For more on idealists versus realists, please watch the episode linked to at the end. For whoever tries to fit their own subjective reality onto the markets will quickly find themselves on a safe path towards the poorhouse. For until this day, square pegs still don't fit in round holes. But enough of market morals. In turbulent times, it pays to look at individual sectors. This gives a more detailed overview of what the macroeconomical map looks like. What I particularly look for is the weakest sectors, because if they have failed to perform under normal bullish circumstances, they will suffer even more when the world economy really turns sour. Identifying such sectors and particularly weak individual companies within them provide remarkably good risk-to-reward shorting opportunities when the technical stars align between the indices and those very sectors. For when things will come crashing down again in the second and bigger and equally unexpected down wave for idealistic retailers, weak sectors will plunge even faster. And when I look at the bigger leading sectors, there is one that truly stands out. One that could rather be likened to the court of Louis XVI. We're talking banks. Just like Louis XVI spent the state's money on lavish palaces, parties, and at rubbing his and his court's own backs, so do banks seem to have an uncanny ability to please themselves at the expense of the taxpayers. It's one big free-rolling industry that has grown beyond healthy proportions. For it doesn't seem to matter how much money we throw at them. They still mess things up from greed and irresponsible policies. Now, don't get me wrong. I don't blame the banks. They simply do whatever is in their best interest. No industry which is offered such golden terms would ever turn them down. And neither did Louis XVI. No, I blame the people in power who allow this to happen rather than trying to find a sustainable solution upon which entire nations are not at the mercy of a clearly corrupted industry. But that won't happen without drama. And just like the French Revolution was the end of Louis XVI and the beginning of new times ahead, so will the next financial crash likely be the death blow for the banking industry. One after which it will be fundamentally restructured and depowered. For in the end, and to the benefit of democracy, the king must die. In this episode, we will mainly look at Swedbank. It is a bank that shows nothing short of weakness, but also one that has a long way down to go, thus making any short positions extra interesting. But to prove my point of how weak the global banking industry is, we will look very briefly at Bank of America and Deutsche Bank. Let's start quickly with Bank of America, but before that, some quick fun stuff. Nothing in this video is financial advice. Everything I say is my own opinions only. Do your own research prior to any investment. And as always, smash those like and subscribe buttons until your fingers turn blue. Since its peak in late 2006 and down to the bottom in February 2009, Bank of America neatly recovered to the Fib 618 level, which as you will see was a strong achievement. Since the February-March crash, the price managed to recover to the 382 fib and was then rejected at the strongest of resistances, the EMA 200 on the monthly. Now, don't get me wrong, I'm sure Bank of America, and any other bank too for that matter, has a long way down to go. But the reason why I don't want to consider them as shorting candidates is because of the extreme fiscal policies applied in the States. Most economists agree that the US will be the last man standing, but also the nation that will eventually suffer the most and involuntarily surrender their financial power position to China. Given that the US, for obvious reasons, has the most to lose from a global depression, they are also the most likely to go to extreme and desperate measures to stop whatever destiny awaits them. For that reason, any stupid level QE program could artificially pump up all American assets, including banks. That, of course, wouldn't mean they're strong. That could simply mean that the dollar enters a final exponential Elliott wave, or that hyperinflation causes prices to increase. And as they seem to be playing Russian roulette over there, a game which I am neither familiar with nor interested in playing, I'd rather stay away. Moving on to Deutsche Bank. Deutsche peaked at 86 euros in May 2007. Since then, the German bank has lost 93% of its company value. In January 2009, at the very bottom of the recession, it was trading as low as 11 euros, thus having lost roughly 87% of its value in just 1 year and 8 months. Today, Deutsche is trading at half that price, not particularly a sign of strength, but rather a clue of more to come. My chart only goes back until 1989, some 31 years, and since then the bank is trading at an all-time low. Going long Deutsche Bank from a technical point of view is nothing short of financial suicide. But as weak as it looks, Deutsche is harder to read from a technical standpoint, given that there is absolutely no technical data available at these crippled levels. For that reason, the only potential shorting opportunity would be if it were to retest the resistance box at 10 to 11 euros. But given that Deutsche Bank is almost dead already anyway, combined with the fact it is difficult to predict due to lack of data, Deutsche is not an ideal shorting candidate. It would simply leave you too much in the dark. That brings us to Swedbank. Swedbank is a Swedish major bank that has been in serious trouble for quite some time, as they were revealed to have, knowingly or unknowingly, laundered dubious money for dubious clients through their Baltic branches. For this debacle, they were fined roughly 400 million euros, a significant amount for a Swedish bank. Now, let's look at some juicy technicals, starting off on the weekly chart. First of all, Swedbank has gone through a significant distribution channel, one lasting for about 3 years. It has a clear 5-way Elliott count with a parabolic wave 5, a long bearish RSI divergence on the weekly and monthly, and some wild sideways swings through the EMAs and Ichimoku clouds, and all beautifully finished with a major distribution sell-off candle. This is as obvious and textbook as it gets. And in a sense, you can say that Swedbank is ahead of the Swedish index development, which probably is somewhere around here. As passionately discussed in the previous episode, the RSI again shows the very same pattern. In September 2007, it made a clear touch on the upper bearish blue. Albeit the RSI found its way above this line, the price did not, and rather confirmed a bearish divergence for additional weakness. Technically, Swedbank has been in a confirmed bearish blue RSI channel since the local bottom in February 2016. To anyone who wants to learn more about the RSI, I am currently working on a full episode about it. For few traders or market participants seem to understand how exactly to use it. Instead, they look at 30 for oversold and 70 for overbought and nothing else, thinking that that's how you use the RSI. But that's as silly as believing that all it will take to fly a jumbo jet is to pull and push the control wheel. Try that and see how far it will take you. Now, after the wild trip to the south, especially in March last year when the 2016 local bottom was taken out, the markdown phase was confirmed. And don't for a second think it will stop here. After the initial plummet, it immediately began forming a descending triangle, which not surprisingly had a false outbreak to the upside, which quickly and aggressively reversed down after also being rejected by the red Ichimoku Kumo cloud. For more on this, please watch the episode How to Beat Technical Analysis in 2020, also linked to at the end. The price has just touched 100 kroner, which is both a minor support level but more importantly the 1.618 fib target. Now I would expect a bounce here, however tiny, either at 100 or in the lower region of the support box at 9280. Especially if the indices were to hover around sideways as predicted, or at least stay above the strong 1240 support box. But once the index plug is pulled, Swedbank could be expected to fall all the way down to the next support box of 64 to 67. This is when I will be looking at taking heavily leveraged shorts, as the upside will be much more limited than that of the indices, and the downside much greater. Depending on how fast the index were to drop, there is a chance that Swedbank could plunge down all the way to 35 without too much of a rest in between. Here is how I'm going to play it. Either I will take a significant short position if prices were to retest the bottom of the descending triangle, which would also likely coincide with the EMA 50 on the weekly, a strong resistance on its own. However, if prices don't find their way up there, a retest of the 9280 to 100 support and resistance box would be highly likely. And as it would then have turned into a resistance, a retest would again be an ideal shorting spot. What I'm not going to do, however, is to try to find any swing longs, as they simply would be too risky. Swedbank has a severe downwards momentum, and trying to detect local longs would from a trading perspective be as dangerous as playing with fire. For look at it. As the indices have experienced some unhealthy and uncalled for rallies since the February-March crash and reached both 0.5 and 618 fib levels across the world, Swedbank barely managed to reach the weak 236 fib level, thus showing nothing at all but weakness. This is the breathing of a dying beast. And perhaps a long overdue one, as the entire banking industry has approached its power position neither humbly nor responsibly. As thoroughly discussed in the December episode, Partying Like a President in a 5-Star Suite, I talked about difficult times ahead, but how they are also necessary in order to burn and bury all the infectious parts of our economy to leave room for new and beautiful life. The way there will be painful, but it will be worth it once we reach the other side. Long term, when the perfect shorting opportunity arises, I say when because I don't believe in ifs in this case. I will sell off a tiny portion of roughly 25% at 64 to 67 and immediately lower my stop loss to break even. Another 50% of my original position will be released at 35 and the remaining 25% will be kept as a free roll in case the bank were to suffer dearly. That was all for now. Thank you and goodbye.